This is Kathy Uckert. I'm a senior analyst at Value Line, and I'm here with Alan House, who's another senior analyst. We here at Value Line hope you and your family are doing well and staying safe. Many of you may be familiar with our flagship product, the Value Line Investment Survey. But we also have additional, more premium services, such as Value Line Select, the Value Line ETF service, and the subject of today's presentation, Value Line Dividend Income and Growth, our premier service. Before I jump into the heart of the presentation, for those of you who are joining us for the first time, I'd like to provide a brief overview of who we are at Value Line. We are a New York headquartered corporation that has been providing investment research for more than 90 years. Our flagship product, as I mentioned earlier, is the Value Line Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on equities that trade on the New York Stock Exchange, the NASDAQ stock market, and the Toronto Stock Exchange. The Value Line Investment Survey also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by Value Line's research department, comprised of more than 70 analysts, economists, data experts, and quantitative specialists. One thing that I'd like to stress is that our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, Value Line has no investment banking business with any company, including all the equities under our coverage. Value Line doesn't execute trades for its subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. If you have any questions about the products or the services that we offer or the different tiers of subscriptions, that information can be found on valueline.com, or you can call 1-800-VALUE-LINE. Reports in the Value Line survey provide a concise one-page overview of a company's operating results, financial position, and forward-looking projections. Value Line Dividend Income and Growth, on the other hand, provides a more detailed and more in-depth analysis of one particular company and an alternative company that we believe is worthy of highlighting. We tell you what stock to buy and when to buy it. We also tell you when it's best to hold the stock and simply maintain your position, neither buying nor selling. Most importantly, and what sets the Value Line Dividend Income and Growth apart from competing services of other providers is that we tell you when to sell, whether that's to maximize your returns or to exit a position that we believe no longer has superior prospects. A few examples of Value Line Dividend Income and Growth buy recommendations include American Electric Power, ticker symbol AEP, which is a major investor-owned electric utility in the United States, delivering electricity to more than 5 million customers in 11 states. The company was added to the Dividend Income and Growth portfolio in December 2011 and was sold in February of this year. We realized a gain of a whopping 274% over that time frame. Furthermore, we purchased semiconductor manufacturer Analog Devices, ticker symbol ADI, in February of 2015. We held our position for approximately 71 months before selling in January of 2021. During that period, we realized a gain of 169%. Another example is Chip Foundry Taiwan Semiconductor, ticker symbol TSM. We bought TSM in May of 2020 and held it for only 8 months before selling it for a stellar 123% gain over that period. Again, if you have any questions about the products or the services that we offer or the different tiers of subscriptions, That information can be found on valueline.com, or you can call 1-800-VALUELINE. Also, please note that this presentation will be available on our website, www.valueline.com, and our YouTube channel within the next 48 hours. Now let's turn our attention and have a brief discussion about the current economic environment. The following content was prepared by ValueLine's senior economic staff. The consumer will likely move into the spotlight now that the holiday season has arrived. Notably, retail sales rose 1.3% month over month in October, which is nicely higher than analysts had expected. Nonetheless, as shoppers head to the stores in the days ahead, it remains to be seen if retailers will have to resort to deep discounts and promotions to remain competitive. Further, consumer debt has been rising lately, which is with some concern. Inflation may have peaked over the summer, but more work might still be needed to bring it closer to the target envisioned by the Federal Reserve. Specifically, the latest report suggests that consumer price inflation has begun to decelerate. However, inflation still runs well above the Federal Reserve's 2% target rate, as measured on the PCE, Personal Consumption Expenditures Price Index. As a result, some economists wonder if the central bank can adequately address this situation, which reflects a complicated set of issues like wage pressures, a constrained labor force, supply chain disruptions, military hostilities, and alternative energy adoption. The Fed has implemented 4 consecutive 75 basis point interest rate increases this year. Most observers think a 50 basis point hike will be passed in December, indicating a softer stance. Elsewhere, the third quarter earnings season has largely concluded. Although numerous companies managed to exceed expectations, earnings advanced nominally, and corporate outlooks have been lackluster. Further, many companies like Meta Platforms, Amazon.com, and Microsoft have announced staff reductions, suggesting expansion is not a priority. The stock market found support in mid-October. The S&P 500 fell to the 3,500 level, but then quickly reversed course. Since then, stocks have managed to rally, but it remains to be seen if the recent strength will carry through the holiday season. From a sector perspective, leadership can be seen in the basic materials, industrial, and financial issues. The technology stocks, which have been vital in the past, have not been fully participating in the upswing. In conclusion, attempting to time the market can be challenging. Investors with longer time horizons should seek out quality stocks that have reasonable valuations. The market is currently trading at a price-to-earnings multiple of around 16, and many issues look compelling. Overall, we continue to recommend that investors maintain significant cash in their portfolios. Now I'll walk you through the selection process for the latest stock to join the ValueLine Dividend Income and Growth portfolio, Illinois Toolworks. Okay, so now I'll show you how to access that. Once you're signed in, head to the dashboard, which is where I'm already located. This is the main landing page for our subscribers, where you'll find economic commentary, supplementary reports, and other up-to-date content. From here, we want to choose Browse Research and navigate. It pops up, navigate to the screener. One thing that I'd like to touch on is that the screener is just one element of our selection process, and it helps us sift through the thousands of equities in our database using targeted, relevant criteria. Anyone can randomly select different screening criteria and come up with a list of stocks, but what separates the ValueLine Dividend Income and Growth is that it's a curated process, starting with specific complementary criteria to meet our requirements. So step 1 is to choose a safety rank of 1 or 2. So you look on the left, and there's the category for safety rank. And we want to focus on companies that are safer than the average equity under our review. Hence, we'll focus on companies that are ranked 1 or 2 for safety. Keep in mind that our safety system ranks stocks from 1 to 5 based on their relative risk profile. So after screening for this, we've whittled our list down to 455. Now, step 2 is to choose a financial strength rating of A+ or better. And then you can see on the left too, screen down there, this is a metric that measures how financially sound a company is. When taken together with an above average safety score, we're focusing on companies that are financially healthy with stocks that tend to be less volatile than the broader averages, the broader market averages, that is. So after screening for this variable, we've narrowed our list down to 132 stocks. Now, step 3 is to select a dividend yield of at least 2%. And we want to also take a look at the dividend yield, because while we're looking for stocks that have solid dividend growth potential, we also want to focus on equities that have a yield. This is at least a yield that's around the value line median. So after conducting this screen, we're down to 64 companies at this stage. And then step 4 is to select a projected 3 to 5 year earnings growth rate of at least 10%. And again, you look on the left for that area. And again, you know, it's also a good idea to focus on companies that are able to grow earnings at a healthy clip over the long term. Companies that can generate solid growth in net income are able to increase dividends if they would be well covered by profits. Now, after running this screen, we've trimmed the list down to 14 names. So the final step, step 5, is now to select dividend growth of at least 10% over the next 5 years. And as the name implies, this product is about dividend growth. Therefore, the final screen will focus on dividend growth of at least 10% over the next 5 years. This is pulling up. And now we see, after this screen, our list has dwindled to just 9 companies. So now we have the 9 companies. And at this point in the process, the spirited discussion begins. Let's just say it was a lively debate. People have strong opinions, and that's a good thing. We don't want groupthink. We want varying opinions. But the opinions are based on data, research, and experience. After discussing the list of finalists with our senior analysts, economists, and statisticians, we decided that Illinois Toolworks, again, that's ticker ITW, would be the best next stock to enter into the value line dividend income and growth portfolio. So we can click right on there onto the Illinois Toolworks page, and that's the landing page for the stock. You can also click on the PDF reports near the top of the page or at the bottom to get a more detailed full report. And we can also take a look at the value line dividend income and growth report for Illinois Toolworks. And then this particular section, you would just go to the dividend income and growth off the dashboard, and there you have the link to the report on Illinois Toolworks. And you can scroll through the report, and if you scroll down to page 11, down towards the end of the document, you can see that we look for ITW to post solid top line and bottom line gains both this year and the next, which is particularly impressive given the recent economic headwinds. While inflationary pressures may have finally shown some signs of easing, we believe that the Federal Reserve might well continue to raise rates, albeit at a more measured clip early into next year. There's also concern that the United States might tilt into a recession next year. However, we believe the company will continue to be able to pass along higher costs to its customers, which augurs well for earnings growth. Subscribers should also note that our Dividend Income and Growth product offers a featured selection, which is Illinois Toolworks this month, while also having an alternative selection. For this month, the alternative selection is Aries Management. And you can scroll up into the document and locate that. And other noteworthy selections, yep, there's Aries Management. Other noteworthy selections for our Dividend Income and Growth product include a section on value line economics. That's towards the top of the document in the early portion. And that reviews the most recent view on the economy and stock market. Also, we have a section that updates the relative performance of both the alternative and featured portfolios relative to the benchmark S&P 500. And that's included in this portion of the document. It should be noted that the stocks we select for Dividend Income and Growth products tend to be more conservative in nature and thus in general tend to perform better than broader indices in turbulent times, but may not perform quite as well during very strong bull markets. Of course, the dividend yield and potential for solid dividend growth provides a degree of stability for investors. We typically try to hold positions in the Dividend Income and Growth portfolio for at least 6 months before considering a sale. Of course, this depends on broader economic conditions and the health of the overall stock market. Product brand awareness, management, and susceptibility to sharp economic downturns are just a few examples of factors that may be difficult to screen for. Generally, we try to diversify the dividend and income growth portfolio across a variety of sectors in order to help boost the overall return. While it may be tempting to focus on stocks in a high growth segment, as the old adage goes, it's not a good idea to keep all of your eggs in one basket. It should also be noted that while we screen for dividend income and growth selections, we also discuss qualitative factors that may add value to the parameters we screen for. The screens are good for quantifying metrics, so sometimes there are qualitative or intangible variables that are difficult to incorporate into a screen. As I mentioned before, the product of brand awareness, management, and susceptibility to sharp economic downturns are a few of those examples. But overall, we hope this gives you a good overview of how we screen for dividend income and growth stocks and what's included in our monthly report. We'll now tackle a few questions. Please note that we typically can't answer complex questions about specific stocks on the spot, but it seems like the first few questions were submitted prior to this presentation. I'll now hand it off to Alan.
Okay, thank you very much, Kathy, for a great presentation. We got a lot of good questions. A few of them were handed in before the presentation, and there was a few more during the presentation. So thank you for presenting those questions. The first question that came, crossed my attention was, is there something in the report to look for when it's best to sell? Along the same lines, someone during the presentation, James, asked, how do you know when it's time to sell the stocks? And there's no, 100%, right answer to that question. We generally buy dividend income and growth stocks with the intention of holding them, for quite a long period of time. We're not, this portfolio is not in the the game of market timing. It's not, out to make a quick buck. It's in there to, generate returns over the long haul. And so one of the things we want to do when we purchase the stock is to hold it for at least 6 months. I mean, there may be, conditions where that's not warranted, but by and large, we hold positions for 6 months, if not longer. And there are many reasons we sell reports to the dig. I mean, we try to keep the portfolio pretty balanced with a certain number of stocks, both in the alternative and the featured portfolios. So we try to, we do add a featured stock and an alternative stock each month, and we generally sell at least one of each month, and sometimes even more to kind of keep the number of names balanced. But, one of the factors we look at is, how long the stock has been in the portfolio for, and we have some names such as PepsiCo that's been in the portfolio for a number of years. And, we have, up to this point and, and I don't see any reason why right now, but we have no reason to, consider selling the stock. So, that's one of the things we look at. Another thing we look at is, as the name implies, the dividend income growth potential. Now, if a stock, if a company all of a sudden states that they're going to cut their dividend, or they're going to maybe slow down the rate of acceleration of their dividend, that would also cause us to raise our eyebrows and perhaps, consider selling the stock. Also, if the stock, has been a very poor performer of late, if it's in a sector that's, getting beaten down by the broader market, an out of favor sector, as they say, that could also be a reason to sell a stock. So there's not one, concrete answer to that, but there are many different reasons why we would consider selling a stock. And, also it could be as simple as profit taking. Maybe, a stock's performed well, an industry that has performed well, and we don't see that much upside potential at the current valuation. And it's in an industry that maybe doesn't have much upside, so we might consider selling it then. So, in a nutshell, that's kind of our methodology as far as selling stocks in the DIG portfolio. Another interesting question, this was submitted by Richard prior to the presentation. He said, do the dividend-paying stocks recommended to have long-term history of raising dividends annually? And that's another excellent question. We do look at and we do screen for companies that have a track record of raising dividends, at a robust clip. We usually look for companies that have been raising their dividend at least 10%, over the last 5 years, and have the potential to raise their, dividends at that rate going forward. So that's absolutely, a factor we look at. As far as that, we want a good dividend paying track record and also prospects for dividends going forward. And as Kathy alluded to during her presentation, we also look at the future earnings potential of the company, because of course, if a company is not growing earnings at a stellar clip, it's not going to be able to raise the dividend, because it won't be able to cover the dividend with net profit. So that's, another reason we look at net profit. There was also another question about, the timeliness and the technical rank. Christian asked about what is timeliness of 5 and technical of 5 mean? I think that's just a general question. I don't think it pertains to Illinois Toolworks specifically, but the timeliness and the technical ranks are both on a scale of 1 to 5, with 1 being the best and the 5 being lowest. And the timeliness measures the relative performance over the next 6 to 12 months ahead. It's based on both technical and fundamental measures, and the technical rank is based, as its name implies, is based solely on technical factors. So I like to look at both of those factors hand in hand, the timeliness and the technical rank, along with the 18-month price appreciation potential capital, the 18-month target price range, which measures depreciation potential over that time. That's a fairly, I guess, about 4 or 5 years ago when we introduced that dynamic into our methodology. I think when you look at all those, you can kind of get a feel of how we think the company is going to perform in the near and intermediate term. So that was definitely another good question. Another question was, how many stocks do you hold in the portfolio? Like I alluded to earlier, there's no set number of stocks, but we like to have approximately 10 to 11 in each of the featured and alternative portfolios. So we have basically the same number of names in each one. So we have we try to keep that number fairly constant. Like I said, sometimes we might sell 2 stocks within 1 month and just buy one, so it might alter the number of stocks in the broader portfolio. We kind of like to keep that pretty consistent. So that was another excellent question. And the safety rank, Christian also asked about the safety rank. That's a proprietary value line measure that measures the relative volatility of the stock compared to the broader market. That's also based on 1 to 5 scale, where 1 is being the quote unquote the safest stock, and 5 is being the maybe more on the more volatile end. So it's kind of like a bell-shaped curve with more stocks being 3 and less being 1 and 5, fewer being 1 and 5, and and then there's some 2 and 4 mixed in. But think of it as kind of a bell curve with 3 probably being the most likely. So that was another excellent question. We take all these metrics together. As I said, someone mentioned the timeliness rank and the tag rank of the stock, but that's not the only thing we look at. And I will address that. Illinois Toolworks, timeliness and technical rank. That's the dividend income growth, as the name implies, we're looking at dividend income growth potential. We're not in this this particular. I mean, we've done well. The returns have done well relative to the broader market averages, especially during the more turbulent times because of its conservative nature. But we're not in it necessarily for short-term gains. I mean, we're in it for companies that can grow their dividends over the long term. So, as far as the timeliness rank goes, that's just one of the factors we look at. Like I said, there's the 18-month appreciation, there's the 3 to 5 year appreciation, there's the safety rank, the financial stability rank. There's a lot of different metrics that go into our decision making regarding these stocks. So I just wanted to point that out. I think I've answered most of the questions that I've seen here. Kathy, did you see any questions that came to mind?
No, I think you covered that.
Okay, well, I thank you all for joining today's webinar. If you have any other questions or want to look further, you can go to www.valueline.com or call 1-800-VALUE-LINE. I thank you all very much for joining this week's presentation.